good, B Hustlers? If you're new to my channel, I go by the name of B, hence the B in B Talks. But anyways, in today's video, I'm joined by a mortgage broker who is in a better position to share with you how to get finance to either purchase your first home, or if you're somebody who is interested to understand how to get loans to fund your property investments, the mortgage broker is the best person to talk about this. Be sure to give a thumbs up to this video, hit the subscribe button, and of course, if you do have any other questions throughout this video, make sure you leave them down in the comment section. In the meantime, guys, let's get started. So I have Shaz here, mortgage broker, who is in a better position to share with you guys how you can get finance. So I've compiled a few questions for you, 10 questions to be precise. Is that a lot?
The top 10 questions.
Top 10 questions.
So a mortgage broker is someone who is in the middle between you and the lenders. But the difference is they will work across all the lenders and do the research for you on your behalf. I suppose a good broker will work after hours, chase the lenders, chase the paperwork, chase the solicitors. You may have childcare issues, stuff that needs a non-standard approach.
If I engage you as my mortgage broker, are you working for me, or are you working for a bank, or are you working for the lenders?
So I'm working for you, or I'm working for the client. Of course, we charge you a fee. Just to be open, the lender pays a fee as well. Once the case completes, they'll pay you a small, called a procuration fee. It's not a commission, it's not a kickback. It's a fee for giving them a client. But at the end of the day, I'm working for you, for your best interest. Because if you go directly to a bank, they're going to work off of their policy, what they can do, what they can't do. What they're not going to do is say, you know what, B, we can't help, but you know what, if you go down the road, Lloyds will help you. They won't do that. So high street banks are quite vanilla, quite standard. You need something more specialist. A lot of those lenders want a broker in the middle.
Some of the people that are watching are aspiring to get into property. Could you just explain to us, how does it all work?
Yeah, sure. So we'll have an initial chat, either a phone call or face-to-face, or just some sort of initial chat around what you want to do now and in the future. And then you'll need to fill in a fact find, we'll do that together. That takes about half an hour, it's about 7 pages, but that investment of time means I'm not going to come back and ask you question after question after question, because it's all there. Once that's done, and we've discussed your priorities around rates and all that sort of stuff, I can then research and find you the most appropriate lender with the costs and so on. And once you're happy to go ahead, we can then submit the case. At that point, that's when a credit check is done, so that it's pretty serious then, like credit check is done on your file. Once the credit check's okay, the lender says, yeah, we're happy to do it subject to valuation. You pay the fees, get the valuation done, and then you pay the legal fees as well, get the solicitor instructed. All being well, you should get a mortgage offer in place within about 2 weeks from submission, as well as valuation coming in. Underwriter reviews the case before they give you the offer, so they may ask for certain documents like proof of ID, address, income, those sorts of things. Once it goes to offer, it's down to your solicitor. So I think, again, as a broker, I will keep in touch with the solicitor, but they're the experts at that stage. So that's more for mortgages. If you're doing stuff like buy, refurbish, refinance or bridging, then it's slightly different. It's quicker, but you have to have a solicitor again who's on the ball.
Is it different if you're buying for your first home to live in as opposed to investment? Is that different? Is it assessed differently?
So generally, any property you're buying to live in is regulated by the FCA, so it's regulated business, whereas anything that's an investment property, subject to certain things, is generally unregulated. So that just means that when it's regulated, there's a lot more questions being asked because the FCA will want to review everything. And the range of lenders is slightly smaller. The specialist lenders who are off the high street, the ones that I tend to deal with, are unregulated as well. So obviously there's a good mix of regulated and unregulated business. But yeah, if it's a home to live in, I think the key thing to consider is deposit. Do you have a deposit? Is it from family and friends? Is it a gift? All those sorts of things have to be ironed out and just trace properly. And how much can you borrow? So on an investment property like buy to let, the amount you can borrow is controlled by the rental of the property. Whereas if you're living in the property, then it's to do with your income. So I guess you've got your residential mortgages, which is where you're going to live. Then you've got the cool stuff that I deal with, which is, so you've got buy-to-let mortgages. So a house where you're going to have tenants in. Then you've got your bridging finance. And then you've got the things in the middle, so development finance, refurbishment finance. And even with the buy-to-let, you can get things like service accommodation mortgages and those sorts of things. But yeah, generally short-term, long-term, residential buy-to-let.
Okay.
Yeah, so in terms of rates and products, you can have a fixed rate, so that rate is fixed for X number of years. Typically it's 2, 3, 5, and some lenders do 10 years as well as a fixed period. The shorter the fixed term, generally the lower the rate, but then it means you're going to have to come back and review that and pay X number of fees again in the short term. Whereas the longer the fixed term, the higher the rate, but then you don't have the ability to review. So it depends on what you want. If you think the property value is going to go up and you may want to release that, then maybe a short-term fixed rate is more important. And this is the kind of conversation you'd have, with a broker. There are also tracker mortgages, so they used to track the Bank of England base rate, but these days they tend to track the LIBOR rate, which is, what's it stand for? The London International Borrowing Rate or something, which is what the Bank of England set as a borrowing rate for all the banks. So they track that. It can go up and down. The flexibility there is they tend to have very limited early repayment charges, so you can maybe redeem or repay early.
So saying that as well,
Yep.
Shaz, if I'm trying to buy to live in,
Yep.
what's the sort of mortgage I should be looking for? Obviously residential.
So it's residential, again, varies on your own personal circumstances, but typically you can get about 4.5 times your income.
Okay.
But then if you've got any credit card loans, overdrafts, any dependents, like kids for example, they'll come off of that and affect that slightly. So lenders will look at income multiples and also monthly affordability. So you know how much can you afford per month, and then it's down to your budget as well. You may be able to afford £4,000 because that's what you've got disposable, but you may only want to pay 1,000, so it's that as well. But yeah, 4.5 times income as a guideline. You can get affordability checks done. There are some, again, brokers will be able to multiple searches and just see what that looks like. Deposit wise, you can get 95% mortgages these days without the Help to Buy, so 5% deposit.
What if it's for investment?
So for a buy-to-let, you can get up to 85% lending. That's with only a couple of lenders, I think Kent, Reliance, Kensington. But the rates will start with a 4. So it's kind of like, do you want to be that highly geared and pay that high rate? Is it worth it? But typically it's 75%. There's also 80 as well. So yeah, up to 85% or 80 or 75. That's your deposit. How much you can borrow really is down to the rental. So when I say that, the rental, they stress test the rent at an inflated rate to make sure it can cover any voids and just kind of support itself. There is a difference though, so if it's a 2 or a 3 year fixed rate, the stress test is quite inflated. If it's a 5 year fixed rate, the stress test is more sympathetic. So I've had scenarios where the customer wants to borrow 75% loan to value, but a 2 or 3 year fixed rate is letting them borrow say 50%. On a 5 year fixed rate, they can borrow what they want. So against that trade off, do you want to fix it in for longer and borrow that full amount or not?
So there you have it, guys.
So you need proof of ID, so passport or driving license. Make sure they're in date. Proof of income, so if you're employed, just say 3 months pay slips. Self-employed, 2 years tax returns with the overviews.
What if you've started a new job?
Again, so these are quirky bits. So if you've gone from self-employed to employed, 3 months pay slips, contract employment, make sure you're permanent, not in a probation period. Just covers off the fact that you're still going to be in that job. If you've gone from employed to self-employed, again, it's fine-ish. Lenders will want to check, is it the same line of work? How sustainable is it? They may even ask for an accountant's reference just to say this is happening. But 1 year's accounts as a minimum, I'd say you need. Okay. So that was proof of income. Proof of address, so council tax statement or utility bill. So yeah, some people maybe still renting, buying their first investment, just get a proof of address for yourself. 3 months bank statements.
Does it matter how long you've been living at the
Yeah,
property?
so you have to give 3 years address history.
Okay.
Doesn't matter if you've moved many times, as long as there's a clear record.
Okay.
And make sure you're on the voters roll as well at the property you're living in now.
Does that matter?
Yes, it does. Have a look at your credit profile. Experian Equifax only, because that's all they're going to use. So I treat the credit file as your finance passport. It shows where you've been, shows where you'd like to go in the future. Lenders will treat that with importance. Now, you may have had some blips, right? And it's okay. Like if it's an unsecured thing, like a mobile phone contract with 1 month that was maybe missed, that can be ignored by a lot of lenders. But then if it's a CCJ or if it's a default, if it's 3 months in arrears, that's when it's a problem. But the key thing is, right, tell your broker everything. Like, there's nothing worse than things happening afterwards when the underwriter sees it and says, oh, what's this about? Because, it makes you look a bit non-credible, makes
Yeah.
and it just the case falls down. So just tell the broker, look, this happened, this is the reason, and let the broker package that in the best way. And if you're buying your first house, if it's purchase, get your deposit together, and also the source of deposit, ideally, has to be in your account for 3 to 6 months.
Okay.
If it's a gift, it can only really be from family, so mum, dad, brother, sister, immediate family. And
So it can't be from your uncle or cousin? Or...
Generally not for a house you're living in. And I know that's bad people, I guess we've got big families.
There
but
you go, I mean, come on, I have to make use of my family, no?
Same. I feel that struggle. Yes, it has to be a gift from immediate family.
Okay.
And they may have to sign a letter just to say they're happy that it's a gift. They may even have to get independent legal advice, which is going to cost you money, but it is what it is. When you send in documents, if it's originals, great. If you're going to send me a pack, an envelope of originals, that's perfect, that's ideal. If you're going to send me email scans...
Can I take a picture, Shaz?
No, you can't take a picture, right?
I'm one of those annoying people who takes pictures of everything.
I'm not going to be her broker, right? The reason is, I have to then certify the document. Say, I've seen the original, this is it. If the photo you send me, I can see your fingertips, I can see hair, I can see the table.
Yeah.
That's not me scanning the original myself.
Okay.
It is really important. PDF, not a JPEG, not a PNG. And worst case scenario, I think there's a free app, cam scanner.
Yes, I've got that.
Steady hand, plain background, just cam scan it. That's fine.
Is that good enough then?
Yeah, but not a picture of a document, please.
No pictures. So if you guys need to go and buy a scanner now, I will leave it directly down below for you to do that.
Fab.
Are you happy with that?
I'm happy. Bridging is really fun. I love bridging.
Is it?
Yeah, pays me more, that's why.
Really?
No, it doesn't. It does. Bridging is ideal, it's useful if you need the money really quickly. So a mortgage takes, residential or buy-to-let takes about 6, 7, 8 weeks to get the money. Bridging 2, 3 weeks.
Wow.
So
that's
imagine
how quick it is.
Yeah, imagine you're at an auction or you want to go to an auction, you have 20 days to complete. You need bridging finance, there's no other way you're going to get that money.
Cover
No
that.
chance. Okay, that's one reason. Second reason is if your intention is to buy, refurbish, refinance, where you're going to buy something, refurbish to add value, refinance to keep the asset and pull the value back out. That's bridging finance, okay? Bridging can also be used for flips. So flips, when you buy a property, add value, and then you want to sell and keep the profit yourself. Bridging can also be useful if you're buying properties below market value. So on a mortgage, if you're buying for £100,000, but it's worth 120, lenders don't care, you're going to borrow against 120. With bridging, it's actually quite similar, so I'd say half the lenders will do the same thing, it's worth what you're buying it for. But there are a lot of lenders now who will say, well look, if the value goes out and it's genuinely worth what you're saying, we'll lend you money against that. And I've done deals where lenders have actually lent against that and it's meant you've had 100% funding. So when people say no money down, hashtag, money in, money out, all that stuff.
Yeah.
The genuine way to do it is to have a genuinely below market value property. Find a lender or use a broker to find a lender who lends against open market value with no caps, and then you can get 100% funding. You still have to pay legals, still have to pay valuation, still pay broker fees.
So you still have to have some money.
You still have to have some skin in the game, right? But, it's the difference between putting 30% down or nothing. So typically, and I'll say typically because lenders will go up and down and there's all these funky things, you can get about 75% towards the purchase price, or as I mentioned earlier, maybe the open market value, but either 75% towards that. You get charged a 2% arrangement fee, which gets added onto the loan. And then just to be transparent, half of that typically goes to the broker. That can be higher or lower depending on the relationships, but that's what happens. You can also get the costs of the work funded. That's funded in arrears, in stages. You have to have some money to start that off. How that would work is the lender will only fund the works if the total loan for the purchase and the work is no more than, say, 70% of the end value. Okay. Most typical is retained interest. So what happens there is a lender will say, okay, fine, if it's a 12-month loan, over 12 months the interest will be 12 grand. They just take that off straight away from your 75% initial purchase loan. When you redeem the loan, you just pay back what you've used, but it means they're not giving you the interest at the start. It's good because it covers their risk, but it is compound interest. You're paying interest on money you actually haven't had in your account, but it is what it is. Second option no one ever does is a serviced interest. That is literally when you pay the interest from your pocket each month. Again, look, you're not going to have tenants in the property, so to find £1,000, £2,000 a month is difficult. The third, not really that common, but it's maybe for larger developments, is rolled up interest. So with rolled up interest, you get a net loan of 70%, you get all the money for the work, and the interest rolled up to the very end. It's similar to retained, except with rolled up interest, you're paying from your profit.
Right.
Okay. You will need a very robust schedule of works. 1 or 2 pages from your developer just showing this is the work we're going to do, this is the cost, this is how long it's going to take. That gets given to the valuer, and when the valuer goes out, they'll comment on 3 things. They'll comment on the current value of the property, make sure you're not buying it for more or less than what it's worth. They look at the schedule of works and think, oh, is this realistic? Is this actually going to be appropriate? Is it costed properly? All that sort of stuff. And then based on those 2 things together, they'll look at the end value. So they'll say, fine, if this work gets done, based on the current market, in 12 months' time, it's probably worth this. So the lender will go with that. You may have given an end figure of, say, 250, and the valuer might say, well, actually, I think it's 225. That's not a deal killer. All that will happen is the lender will say, well, fine, look, you said you were going to refinance this property. Based on what we've got, you've got to find 10 grand to put it back in. Right. Can you just show you've got that? Is that enough detail?
That's incredible detail.
Never go on a bridge unless you have an exit plan first. So start with the end first. So if your exit is to sell, fine. What's the end value of the property? How much is it going to cost to buy it? How much is a refurb? What's the cost of the funding? So the interest and fees. When I sell it, is anything left over for me? That's flipping. Flipping, to be honest, generally tends to be okay. If your exit is to refinance, so again, to buy, refinance, same sort of principle, but what you've got to really consider is when you refinance, you're only going to pull out 75% of the new value. And in a lot of cases, you're leaving money in the deal. It's not a bad thing, as long as you know you're doing that and you have the funds to make that happen. And also the lender will want to make sure you have that up front before they even put you on the bridge. So with bridging lenders, they're not that concerned with you as a client, they're more concerned with the project and the exit. So what you're going to do with the property, how are you going to pay us back? That's what they're concerned with, and that's what you should be concerned with, is how am I going to pay them back?
Typically, most people want to start with buy-to-lets. How does a person get started? What are the sort of barriers as well with it, and challenges that you can face as well if you're not prepared?
So first of all, like we touched earlier on, get yourself mortgage ready, get all those documents in place. In terms of challenges, especially when you're new, there's 2 things. You could be a first-time landlord, but you already own your own home that you live in. That actually now is fine. Most lenders are okay with it because you own your own home. As long as it's a single let, buy-to-let. So if you want to do something funky like a HMO, there's only one lender who does a first-time landlord on a HMO, which is Kevin Lyons.
Oh, right, okay.
Because for HMO, they tend to think you want more experience. Okay. However, this is where it gets more challenging, is if you are a first-time landlord, first-time buyer. So a lot of young investors, especially nowadays, maybe living at home or renting, but want to buy their first buy-to-let property. The only challenge you'll face is the lender has to mitigate the risk that you're not going to just live in that property because the mortgage is cheaper. So the way they do that is, generally on a buy-to-let, how much you can borrow is dictated by the rent. However, if you're a first-time buyer, first-time landlord, they'll assess it based on your personal income, as if it was a residential mortgage. As you scale up and you get bigger and you get more properties, the only other things that come up is when you are a portfolio landlord, so 3 or more mortgage properties. Then they'll want to stress test everything in the background as well, to make sure it covers itself. But yeah, with buy-to-lets, it's pretty straightforward, like say up to 85% loan to value, although 75% is more reasonable in terms of rates. With legals, they have to understand what they're doing. So, and with bridging as well, to go back, and buy-to-let, it's 2 different things. So for bridging, you have to have someone who's very specialist and understands bridging. Don't use your solicitor for your buy-to-lets, it's not the same. The example I use is like a doctor and a dentist. They're both medical professionals, but in completely different things. So make sure you've got a really good solicitor. The other thing to mention as well is a lot of lenders will have a specific panel. So they might have a list of say 25, you have to use one of those. And in terms of costs, right, you have to obviously pay for valuations and broker fees. But in terms of solicitors, you're paying for your solicitor as well as the lenders. So it's a cost some people don't realise, especially first times, like, oh, I've got to pay for that as well. Yeah, you've got to pay for that. On a buy-to-let deposit, right, it has to either be your own funds, it can be family gifted. If you have investors investing in you on a buy-to-let, Lenders don't tend to like it unless it's a limited company and that investor is also a shareholder in the company, because then it makes sense that they're funding the project.
Okay.
On bridging finance, a lot more flexibility. You could have like 3 investors putting loans in, you can have a gift. The bridging lender just wants to see the loan agreements, a gifted deposit letter, and they just want to make sure that when you refinance, all of that's going to be cleared off.
You heard it here first, guys.
Lenders are happy then. You own your own home, you can get a buy-to-let fairly easily as long as you have a deposit.
Okay.
The more creative stuff is you could, if you have equity in your residential home, you could potentially leverage that either by releasing the money as a remortgage or a further advance, using that as a deposit. The only thing with that is if you are with a high street lender, so your Barclays or your Lloyds or who else, Santander for example, most of those lenders don't like lending any of the money for what they call business purposes, and they would class purchasing a buy-to-let as a business use.
Right.
So if that is your plan, you then maybe have to look at a specialist lender off the high street. Again, brokers can come in and help you with that.
I was about to say.
But yeah, so you can use equity in your home to start that investment journey. You may not have your deposit, but you can use that. If your plan is to do bridging, if it's suitable, then, and this is where it gets clever, is like, so like say you have to put a 30% deposit down, yeah? What you can do instead is say, well look, I'm not going to give you cash. What you can do is for the 12 months put a second charge on my residential house, because the equity is there.
Yeah.
And it's one of those things where it becomes no money down, bar the fees.
So you're kind of in a good position if
you're in a good position,
off with,
because you have an asset.
Yeah.
Straight away. So I'm seeing for buy-to-lets, the difference in the rates when you're in a personal name versus limited company getting a lot larger for some reason. So rates on personal names are actually as low as they've been for a while, and the limited company ones are getting slightly higher.
It's because so many more people are.
I think because many people are applying in companies for tax efficiency, and everyone wants to cut that pie, don't they?
Course, yeah.
It is what it is. In terms of trends, I think lenders are always like a year or 6 months behind what's actually happening.
Okay.
So whereas now and 6 months ago it's always been popular to do short-term lets like Airbnb, that sort of stuff. Another thing I'm noticing is, again, trend-wise, a lot of people in the Midlands especially are doing social housing, where they're getting like registered charities to put in ex-domestic abuse victims, military, potentially vulnerable people. It's good for income because there's guaranteed rent, no voids, and you get more rent than you normally would. Typically lenders didn't like it because the reputational risk of kicking those people out would be really bad. But again, there is an appetite that's getting bigger and bigger now.
Okay.
I'm seeing that. But yeah, I think service accommodation definitely is a hot one.
It's a hot one, yeah. And now lenders as well are.
Yeah, what's interesting about that is, and I think sometimes lenders speak differently than investors. So investors will call it service accommodation when actually it's like your nan's house on Airbnb. From a lending point of view, that's just a short-term let.
Yeah.
So the difference is typically on your buy-to-let mortgage contract, it'll say you have to have a 6 or 12-month AST, tenancy agreement. The only difference is now, if you say you're going to do the short-term let, they'll just give you the allowance to do that. They'll still stress test it on market rent, make sure it works as that as a backup. But if it doesn't, you can do either or. That's the difference. So it's short-term let rather than service accommodation.
Okay. And that leads me to my last question.
Wow, finally.
It wasn't that hard, was it?
That's fine. So I would say plan ahead. Always plan. Don't rush into anything. If you're going to pay people money, whether it's for deal sourcing, mortgage broking, solicitors, accountants, do your own due diligence. I can't stress that enough. Make sure the people you're working with, you know them, you like them, you trust them, and actually they're good at what they do. And you've got evidence of that. Make sure all your numbers work. Just make sure everything stacks up, because the worst you want to do is spend money on something and you're stuck. Especially with bridging, as I say, don't go on a bridge. You can't exit the bridge, and you know that. You don't risk it. Other thing I'd say is it's network. So, like, property is this big. Property investment then is a niche within that, and what you find is there's an active community. So if you can't physically go to a networking event, there's online groups. There's loads of groups. Just search for them. They're on there. Within those groups, you can ask a question, and people will help you. Like, no one is there to be shady. So people will just generally help you up front. If you feel you need the extra push or accountability, then education and courses are there. But again, do your own checks on them. Make sure they're legit. I work mainly with property investors, which means I do a whole lot of bridging, development and refurbishment, buy-to-lets, HMOs, and longer-term investment mortgages. I'm on LinkedIn for the business-to-business stuff.
Yeah. I'll leave all his social media handles in the description bar below.
In the description, and if you like this video, click subscribe.
Go ahead and hit that subscribe button. Thank you guys for tuning in. In the meantime, continue being
Hustlers.